Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts.
This idea of a valuation rally, meaning we could possibly, and again, this is something we kind of conjured up, John Ross and I, to a degree, on this idea that if we see central banks finally start taking some money off the table, maybe money comes out of the financial economy and rolls into the real economy. If it rolls into the real economy, you have to say that U.S. assets relative to the rest of the world look very, very cheap. And if money starts flowing into the real economy for a change, that means you finally get the ability to grow, and U.S. small business grows, and U.S. jobs are created based on small business. So this idea of a valuation drain from the central banks, which looks very bad for financial assets, in the end could ultimately create a growth surprise in the U.S. This is number 3 in terms of our scenario hit parade, but it's something longer term in the background and we keep an eye on. It's hard to even think of this scenario given the awful condition, U.S. fiscal condition and everything that we see on a regular basis flowing out of U.S. economic policy. But again, it's a scenario that has some degree of plausibility that we've developed and are watching. And that's all I have, Steve.
So, Jack, I want to remind all the attendees that they can sign up for the Currency Currents. Jack and his son, JR, they write each and every day, which I have no idea how you do that each day, Jack. You create some really insightful material every morning.
We drink a lot.
I'm not sure what time you get up that early to get it to our computer so early, but please sign up for the Currency Currents. That's their free newsletter. After that, they make trading recommendations, whether it's in the spot market, the currency market, the options market, lots of places, but you might want to sign up for the Currency Currents, at least initially, and then move on. You can go to blackswantrading.com, learn more about Jack and his son. You could write some email if you want to contact them, info@blackswantrading, and as I said, they have subscription-based letters on options, forex and futures, emerging market currencies, which are obviously very interesting, and currency ETFs. So lots of stuff there. Very few, if any, are focusing solely on the currencies. So Jack and his son do this each and every day. I'd urge you to sign up for the Currency Currents, as it's really, I think it's the only place that you can really read something about the global marketplace that we're in, and it really is amazing stuff. So please sign up for that. Jack, why don't we take some questions?
Great. Happy to.
Tons came in, so let's see. Do you want to take them? Why don't you just pick the ones that are best, and I'll take a look also if you see one that seems to make, well, all the questions are good, so it's just a matter of...
I see one up top here. What is your view on gold? If we see a crisis that allows the U.S. dollar to recover, will gold act as a safe haven? That's a good question, and I mean, obviously a great question, because gold is playing such a central role now, it seems like, in terms of money flow. One of the things, if you look at long-term charts and you look at the U.S. dollar against gold, there's always been I say always, since 1971 when the dollar started floating, floating meaning moving on supply and demand basis, where governments couldn't set its price. Every bear market in the dollar has been met with a bull market in gold, and vice versa, longer-term basis. But the reality is we're in kind of a different situation here to a degree, and we saw it during the credit crunch. We saw the dollar rally during the credit crunch, as I said, when that money moved back into the U.S., but if you look at some charts during that period, gold also rallied along with the dollar at that time. We think a lot of that was money coming back into the U.S., obviously, that pushed up the dollar, but there was also money that didn't want to come back into the U.S. and didn't want to necessarily hide in treasuries, and I think a lot of that went into gold, and I think most of it may have been, well, not most of it, I don't know what the components were, but I think some of it may have been European-based, because at the time, you may remember, we had those European countries, Eastern European countries, really teetering on, sovereign default. So there are periods, I think, during these crisis periods, these risk events periods, where they can move together, because both of them are playing that safe haven role in a very, very big way. I think in general, and Steve and I were talking about this when we started, gold is reflecting a lack of just a lack of confidence in all the world governments, for very good reason, obviously, and all paper in general. And the reason I say that is there's been a little bit of a disconnect between gold and the dollar pattern, or the correlation. Gold has blown off, as we know, to a pretty massive new high, but as I showed you on the chart, the dollar's still 7% above its recent low. If the correlation, and if it were only a dollar story, I think you would see the dollar back already through its old low and and into new low territory all time, but we haven't. So at least from that standpoint, there's a little bit of reflection on it's more than a dollar problem. I think a lot of players are really nervous about the disconnect that I described in the real economy and financial economy, and obviously all the paper being thrown out there in the world by all the governments. One number that I think is most startling and is $17 trillion. Since the credit crunch started, $17 trillion by the governments in direct stimulus into the market of taxpayers' money from the major governments around the world, and we really haven't seen too much of a rebound in global demand. That's kind of scary, and I think gold is reflecting some of that, because when you think about it, what's left if we don't get a rebound in the global economy? The major governments of the world are running out of our money, and they're running out of interest rate stimulation. So I think it makes sense, and then that's why gold is moving.
Hey, Jack, how about this one? I've seen this question often in other webinars, and the question is, Jack, when trying to build a case for a strong or weak U.S. dollar, and if we were able to do so, how do we extend that to the other currency? As you mentioned, one of the things that a lot of investors have a hard time with is actually looking at two or the pair at once, where people tend to say, love the dollar, hate the dollar, and they don't know what that means relative to another currency. What do you do with that, Jack?
Well, it's not an easy answer, but we could even do something on this. But in the currency world, there's really three baskets of currency. There's the dollar, and then there's three other baskets. There's the commodity currencies, Australian dollar, Canadian dollar, New Zealand dollar, of the majors, South African rand, and the BRIC countries are generally commodity currencies. Then you have the savings currency, the old line savings type currencies. Those are the, aging demographic places, and that's why they call them savings currencies, the euro, Swiss franc, British pound. And then you have the trading currencies, those countries and currencies that are driven mostly by trade in the world, exports. Asian bloc, for example, are the major trading bloc currencies. So if you understand that, and all of a sudden the dollar starts to rally on an event which commodities start to sell off, and it's a commodity type event, some type of thing, commodities, major deflation. Major deflations tend to be good for world reserve currency, the dollar. But if major deflation starts to hit the commodities in some way, then that would be your choice of currencies you'd want to go for. If it's something else, like there's something in the world in terms of a major risk event, in Asia coming from China, in terms of just global demand falling off the cliff, you're going to hit both those classes because the commodities have been driven by China, but there are periods where the commodity currencies aren't all China driven. But let's try and parse this a bit and say there's a problem on the export side of the fence, global demand isn't rebounding, then the export currencies, which would be the trading currencies, would be the ones that you'd want to go against, so to speak. And same way for the savings. So if you try and break them into those three baskets to a degree, that gets you in ballparks. In general, given what's happening in the world today, you're seeing pure risk appetite, pure risk aversion, meaning the dollar's going one way and everything else is going the other. So if you make your dollar bet right, you're going to do pretty well just picking any other currency. But if you can refine that a bit, you're actually going to be a little better off. So hopefully that helps.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.